Donald Trump's new One Big Beautiful Tax Act could mean a dramatic increase in taxes for many European investors. This is one of the most disturbing investment tax increases that I have seen over the 18 years of my professional experience, either during my time working on Wall Street or while running an investment company here in Europe. And actually, the potential tax increase is not even the worst part. So let me explain what's happening and how to prepare. Okay, so here is how the US taxes European investors right now, and I'm going to use a simple Google Sheet to illustrate it. Let's say you own some Coca-Cola stock and you get $100 in dividends. Well, as a typical foreign individual, you would get taxed at a rate of 30% by the US government before the money reaches you. Okay, so you pay $30 in taxes, you get $70. Now, most of us live in European countries which have a good tax treaty with the US, and this rate gets reduced to 15%. So you pay $15 in taxes and you end up with $85. Now, if you're not investing in individual stocks, if you invest in index funds and ETFs, then you don't get taxed directly. But for example, an Irish ETF investing in US stocks also pays the 15% tax rate. So effectively, you're still getting $85 out of every $100 paid in dividends. Trump's new tax act would add a new Section 899 to the US tax code. And this would increase the tax rate for investors based in countries which, in the opinion of the US government, have tax laws that are unfair to America. For example, Trump doesn't like digital service taxes, which target big US tech companies, or the undertaxed profits rule, which targets global companies which pay very little tax. And by the way, this rule is already widely implemented across Europe, with the exception of a few smaller countries in Eastern Europe. So that means that Section 899 would affect investors in most European countries. For affected investors, this tax rate would start going up 5 percentage points per year. So first you would see 20%, then 25%, then 30%, and then 35%. Okay, the maximum increase is capped at 20 percentage points. So after 4 years, you would only get $65 out of every $100 paid in dividends. Now, to be clear, this act is not yet law. It has been passed by the House of Representatives, but not yet by the Senate. So in the US system, that means it can still change. It's also not fully clear how this new Section 899 would interact with existing tax treaties between the US and other countries. But this is the general idea. So what does this mean for European investors? Well, it's kind of like a layered cake of bad news. There's the obvious problem up top, and then you keep digging down and you see more problems, which could actually end up being even worse. The obvious problem is when taxes go up, your net profit goes down. So for example, if you are a dividend investor, if you are investing in a fund like the Wisdom Tree US Equity Income UCITS ETF, which focuses on US companies that pay a lot of dividends, well, we can see here on Just ETF that the current dividend yield for this ETF is 3.3%. So if dividend taxes go up by 20 percentage points, that would mean that out of this 3.3% per year, 0.67% would now go to the US government. So this would actually be a huge reduction in your income. Your additional US taxes would eat up 1/5 of your dividend income. Now, for most of us, we don't have a dividend-heavy strategy. We invest broadly in the market, like in the S&P 500, for example. And fortunately, in that case, the direct impact is actually not so big. Now, why is this? For one thing, American companies have been paying less and less in dividends in recent years. Instead, they have been doing what are called share buybacks. This can be really attractive for investors in these companies because when you get a dividend, you always have to pay tax. But if there's a share buyback, if the company goes out and buys back its shares, you can choose, do I want to participate, sell my shares and get some cash? Or do I want to hold on to my shares? And then I have no taxable event. Okay, so in America, these share buybacks are more popular. That means dividend yields are lower, and there's less of an impact from these extra taxes. And the other thing is that American stock valuations are relatively high. Stocks are relatively expensive after many years of going up and up and up. So the dividend yield, how much the company pays in dividends compared to the stock price, it's quite low. We can look at this S&P 500 ETF, for example. The dividend yield is only 1.1%. So if you have an extra dividend tax of 20%, you're only giving up 0.22% per year. It's not nice, but it's not the end of the world. But there are at least 3 more layers to this bad news cake that you need to be aware of. And I'll explain that in a second. But first, I've noticed that only around 24% of our channel viewers are subscribers. So when you subscribe, you get reminded of new videos, and you also help other people discover the channel. So thanks for doing that. Okay, the second layer is capital outflows, and here's what that means. If this new tax system goes into place, investors in Europe and also in other global countries which will be affected by this will start to look more negatively at American investments. Okay, they will start pulling out some money, or they will put less money into the US market. And this can have a significant impact on US stock prices. It can mean a significant drop in stock prices in the short term as people pull out money. And even over the longer term, the stock market is all about supply and demand. So if there is less demand for US stocks, this could depress US stock prices longer term. Now, to me, this is just a normal market risk. It's part and parcel of investing in a global portfolio. I'm personally not too bothered by it, but it's something to be aware of. Okay, you might see this kind of drop because people are pulling out money. But then we get to the next layer of the cake, which is if a lot of foreign investors pull money out of the US market, this would have a negative impact on the US dollar. It would get weaker. And for those of us who are still holding US stocks at that point, when you translate that stock price from dollars into euros or pounds or francs, it would be worth less. So again, especially in the short term, this could have a significantly negative impact on our portfolios. I've done videos about currency risk before. For long-term stock investors, it's not such a critical issue. This is not keeping me up at night, but it's something to be aware of. And then there's the fourth layer of the cake, which to me is the most disturbing. But before I get to that, I want to show you one way that exists which could potentially allow you to completely sidestep this new increase in taxes. Right now, today, there are some ETF investors who pay 0 dividend tax on their US investments. That's right, 0. How is this possible? Well, they're not cheating or doing anything illegal. They are buying so-called synthetically replicated ETFs, also called swap-based ETFs. Now, a typical US stock ETF, also called a physical ETF, actually invests in US stocks. So for example, if you buy an S&P 500 ETF, it will invest in Apple and Nvidia and all the other big American companies. A synthetic ETF doesn't do that. It gets the same result as the S&P 500 by using financial wizardry, something called swaps. I'm not going to get into the technical details, but the way things stand right now with the current US tax law, because of this financial wizardry, the ETFs don't have to pay these dividend taxes. So if we go to our table with a synthetic ETF, the tax rate is 0% and your tax is 0 and you get the full $100 in dividends. So looking at the situation as it stands, you would think that you could buy these synthetic ETFs and not worry about Trump's new taxes. Unfortunately, though, it's not a sure thing. There's a lot of uncertainty around how the new rules will get implemented. It's possible that where you had 0% tax before, now that's going to go up by 5 and 10 and 20%. It's also possible that if a lot of foreign investors start using these synthetic ETFs to sidestep the tax issue, then the US could close the loophole. But certainly with synthetic ETFs, your chances are better. Just make sure that you research synthetic ETFs before investing because they do have some slightly higher risks than regular ETFs. At the end of the day, though, there's another layer to the cake of bad news, which unfortunately makes even synthetic US ETFs seem a little bit suspect. And it's what Trump's actions signal about the future. Today, the US is going after dividends paid to foreign investors. Tomorrow, what if they target capital gains, the profit we get when we sell? Or what if Trump decides that he wants to put in capital controls and prevent money from leaving the US? It would seem completely inconceivable in light of the history of the US market and how America has always pushed free markets around the world. But looking at history, other countries have done this on occasion, and this has really hurt foreign investors. I completely understand the many worried messages I've been getting about this from viewers. We are supposed to be protected from this kind of country-specific risk by diversification, by buying a global index fund or ETF which invests in many different countries. But an all-world ETF today invests 60% into the US, so we are very vulnerable to the decisions of one person. So what do you do? Well, there's a few different options. Now, for passive investors, the first and default option should always be do nothing. Keep investing passively in a global portfolio. Because every time you make a move based on news headlines, the biggest risk is that you mistime it, you make a mistake, and you screw it up. For example, right now, the dollar is weaker, so the value of US stocks in our portfolio has gone down. European stocks have already gone up. So if we now sell cheaper US stocks to buy more expensive European stocks, we can just be making a mistake. You also have to keep in mind that many changes that Trump says he will make don't actually end up happening because he gets pushback. And also, the US stock market has tremendous potential with the AI revolution taking off. Okay, so it's not at all clear that now trying to change your strategy will lead to a better outcome. Now, if the Trump risk is keeping you up at night and giving you a lot of stress, you do have other options. The second option would be to add more of a home bias to your portfolio. A lot of academic research supports this. You could invest more in Europe. If you go on justetf.com, you can find a lot of ETFs which focus on Europe. So putting more of your money closer to home protects you from these political issues. And the third option for those who really want to stay away from America is to look at ex-USA funds like these, where you can avoid investing in the US stock market altogether. But of course, this way you are avoiding both the risk and the profit potential if the US market keeps outperforming. In my own case, I'm a big believer in passive investing. I've seen so many people make mistakes trying to change their strategy based on news headlines. And also, I have some business interests here in Europe. I have some other assets. I'm not overexposed to the US, so I'm not changing my portfolio. My ETFs will keep investing in all world stocks, and that's fine. That said, if I were starting over from zero, I would probably add more of a home bias and put a bigger chunk of my portfolio in Europe. Now, if you're concerned about what's happening in the market and what you as a European investor should do, you might want to join over 70,000 readers in my newsletter for European investors. Just click the link below this video to sign up.